Vetri, there is a question to you on the consumption story which is playing in India. So the Indian economy is actually projected to become the world's third largest consumer market by 26. The recent report says that, right? So, however, the consumption growth has actually lagged the investment growth in the, especially the last couple of years since the pandemic, particularly since mid of 22 onwards, right? So, what are the headwinds that actually you see in terms of which are actually delaying the growth, and how is the earnings trajectory for this sector is also looking like?
Sure. So, I think that's a good question, Niranjan. And I think it's a good question because we have to understand that most economic trends always have an underlying element of cyclicality within them. When we extrapolate from today to 2047, it's very easy to extrapolate in Excel a straight line which doesn't show any volatility. But what history tells us is that economic growth always has its own cycles. There can be periods during which consumption could grow faster than underlying, economic growth, and there can be periods where investment might do better relative to, GDP growth. As an example, exports as well at some point could do better than GDP or could do worse than GDP. So there are cyclical elements. It is never that it is always a consistent straight line. That's point number one. I think we've already discussed in the past some of the reasons as to why consumption growth in India has been slightly weak, and this is simply a function of the pandemic in many senses. If you actually look at per capita income growth, so we are looking at each the GDP of the, not the total GDP of the country, but GDP per capita over a 5-year period ended FY24, the per capita income growth is only about 3% because of the setback that happened during the COVID period. 3% per capita income growth is one of the weakest numbers over a 5-year period compared to the last 30 years of historical data that we have, and I think that is the number which is causing the actual company numbers to look weak, because clearly consumers don't have the ability to spend because they are still sort of setting their balance sheets in order, or perhaps they have borrowed through that difficult pandemic time and therefore are trying to pay down those loans at this point of time. So it's hard to know all those reasons, but I also think that there is some reason to be slightly optimistic about the fact that so far the recovery has been what we have popularly called K-shaped, which means the top end of the pyramid has done very well, the lower end of the pyramid not so well. But we also know that some of the areas like real estate are picking up, and when real estate picks up, it tends to be a very good job creator in the short to medium term, and particularly it can absorb a lot of the surplus workforce from the agriculture sector, including unskilled labor force. So I would be slightly optimistic that we have perhaps seen the worst of consumption data. It could slightly start to turn marginally from here, but at the same time we have to be cognizant of the fact that consumers have gone through a difficult time. Maybe on a relative basis the valuations of these companies also needed to derate because they were trading at very high multiples even going back 2 or 4 years ago. So that has also contributed to some kind of underperformance by the stocks. But fundamentally the business models of many of our consumer companies is strong in terms of the kind of cash flows that they throw up, the return on capital that they have, and we know that in the long term the stock market returns of a business are closely related to its EPS growth, which is also a proxy for return on equity, and therefore I would look to that as being the long-term trajectory. But right now the cycle is yet to sort of turn up in terms of demand.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.